Hi viewers, welcome you once again to Micro Learning. This is again Shailaja. So today we are going to see 5.5.5. That is, it's an interesting topic. Previously we have seen what are the effects of production, effects on production and effects on distribution. So today we are going to see measures to control inflation. So let us go into the Now we are going to see what are the measures to control inflation. There are three measures told. Okay, the first measure is supposed to be monetary measures. Second one is fiscal measures. And the third one is going to be other measures. And who has coined these concepts as? It is Keynes and Milton Friedman. Together they have suggested three methods to control inflation: monetary measures, fiscal measures and other measures. So let us look into the monetary measures. Now let us know what is first monetary measures. Monetary measures is nothing but control of money supply and how we are going to achieve economic growth. That is what we call it as monetary measures. That is how to control the money supply, and from that how are we going to achieve economic growth. So, monetary measures is adopted by the Central Bank of India. They are increase in bank rate. What do you mean by increasing bank rate? The bank rates is being increased by the RBI. Okay, and when the interest rates are increased by the central bank, automatically the commercial bank has to follow the bank rate. Second one is supposed to be sale of government securities in the open market. The government can sell the securities, okay, in the open market. So any investor can purchase the securities from the government. Next one is supposed to be high cash reserve. That is we call as CRR. And the next one is statutory liquidity ratio. So all of us know what is CRR, that is cash reserve ratio. What is cash reserve ratio? Every commercial bank, what it has to do? It has to maintain a reserve. Where it has to reserve? Reserve, it should be kept in the RBI. Okay, every commercial bank is supposed to maintain a reserve. Either it can place it in the form of cash, or it can deposit with the RBI. So this is regarding cash reserve ratio. The next one is supposed to be statutory liquidity ratio, SLR. This also you know about banking, because you are all commerce students, you will be knowing it. So it's nothing but the minimum deposit, say a percentage of deposit that has to be kept in the that the commercial bank has to maintain. Okay, it should maintain in the form of liquid cash, or it can maintain in the form of any other securities like gold as such. So this we call it as a statutory liquidity ratio. The next one is supposed to be consumer credit control. Okay, consumers credit. You know, generally the public purchase in the form of credit. So what happens is, for any business purposes, you have to sell the goods by extending credit to the consumers. So this is called as consumer credit control. That is also controlled by the RBI, because it's RBI's instruction that the commercial banks has to follow, and the credit has to be controlled whenever the order comes from the RBI. The next one is supposed to be high margin requirement. High margin requirement is nothing but the currency value of the security offered, that is for loan, and the value of loan that is going to be granted. So this is called as high margin requirement. What level of loans has to be given for the securities. Next is, all of us know about the repo rate and reverse repo rate. This is regarding the monetary measures taken to control inflation. The next one is supposed to be fiscal measures that has to be taken. Fiscal measures is now recognized as an important instrument to tackle inflationary situation. And we can see the major anti-inflationary fiscal measures is reduction of government expenditure. So government expenditure has to be reduced, public borrowing, and enhancing taxation. So you can encourage public borrowing as well as you can enhance the taxation. That is, you can higher the taxes as such. Next one is we have some more measures.